Tanker Market Update, 13th of January 2026. Escalating conflict between former President Donald Trump and Federal Reserve Chair Jerome Powell over interest rates is creating unprecedented institutional risk in the United States. While markets appear calm, political pressure on the central bank undermines credibility, raises long-term funding costs, and increases volatility across commodities, including oil. This macro instability amplifies price swings and disrupts global trade flows, making freight rates more unpredictable. Iran has returned to the center of geopolitical risk. Ongoing unrest, combined with explicit United States threats of sanctions, tariffs, and potential military or cyber action, has pushed oil prices higher despite an oversupplied market. Iranian exports are already declining, with more crude held in floating storage. This raises uncertainty around sanctioned barrels and increases the risk premium on Middle East tanker routes, keeping freight volatility elevated. Venezuela's story is shifting from sanctions to rerouting. After Maduro's removal, Venezuelan crude is slowly returning to market under United States oversight. Production growth remains limited, but heavy Venezuelan barrels are now moving toward the United States Gulf Coast, boosting short-haul Atlantic demand and reducing long-haul flows to China. Asia and Europe face sharper alignment choices. China is pressuring European states on Taiwan while courting others as stable trade partners. Venezuelan crude may return to China selectively and at higher cost, increasing fragmentation in crude sourcing and embedding political risk. Overall, sanctions, tariffs, regime shifts, and institutional stress are redistributing barrels, extending voyage lengths in some corridors while shortening others, increasing volatility, and embedding geopolitical risk into freight pricing. For tankers, the upside is volatility and ton-mile complexity, not demand growth alone.